All right, well, good morning, everyone. My name is Molly McGurr. I am the Event and Program Manager for Traverse Connect, and we're so excited to be able to offer you this webinar today. This webinar is for you to ask any and all questions that you may have, so we definitely encourage you to do so throughout the webinar that you're going to see. To ask questions, you're going to find a Q&A button located at the bottom of your screen. Feel free to use that Q&A button to submit over any comments or questions. I never read the person's name asking the question, but if you don't feel comfortable asking, there is an anonymous button as well that you can use. And we will be going over all questions that are being asked at the end of the presentation today. I also just wanted to note that this presentation will be recorded and shared on the Traverse Connect website and YouTube page within 24 hours. So on that note, I would now like to turn it over to Brenda McClellan. Brenda, thanks for being here with us today.
Thank you, Molly. I am Brenda McClellan, and I am the Director of Investor Relations with Traverse Connect, and have the pleasure of introducing our speakers today. And joining us, we have Kimberly Schwager. Kim is a principal with Raymond's tax team, providing a variety of tax consulting services, as well as income tax planning and preparation services to individuals, corporations, and partnerships. As a trusted advisor to both medium and large size clients, Kim uses her deep technical knowledge to translate complex tax regulations into proactive ideas that help her clients succeed. As the need arises, she provides clients with direct access to Raymond's broad range of tax and other consulting specialists. Kim is a member of the firm's real estate advisory team, working with industry specialists from around the firm to share best practices. She serves many clients in the construction, oil and gas, agribusiness, manufacturing, retail, and service industries. And we also have with us Thomas Szymanski. Tom has served clients in an advisory capacity, providing outsourced and interim CFO services, business financing solutions, turnaround management, strategic planning, system implementations, and transactional advisory services. Tom has nearly 20 years of experience as a financial officer, and prior to joining Raymond in 2017, Tom was a founding partner and CFO for a business consulting firm that primarily served small and middle market companies. Tom has significant experience in financial executive leadership, business financing and debt restructuring, facilitating rapid turnaround to profitability, and assisting organizations through ownership transfer and leading company acquisition teams. And finally, we have Ryan Sullivan. Ryan is a principal and managing director with Raymond Wealth and is based in the Traverse City office. He provides direction to all financial service divisions of Raymond Wealth. And Ryan also serves as a member of the Raymond Wealth Executive Committee. Since joining Raymond in 2003, Ryan has worked with individuals and families building creative strategies to help clients approach and reach their financial life goals. Ryan also works extensively with business owners and their employees in an effort to establish and maintain the most effective group retirement plan solutions. He has earned his certified financial planner certification and holds numerous securities, registrations, and insurance licenses. And with all of that, we will kick it off with Kim. Thank you, Kim.
All right. Yeah, good morning, everyone. Thanks so much for joining us today. We've seen a flurry of changes and guidance related to the PPP program. These last couple of weeks, we've got a lot of ground to cover and want to leave plenty of time for your questions, so we'll jump right in. First, a quick history of the PPP program. It's hard to believe it wasn't even 3 months ago. It was March 24th that all non-essential businesses were shut down here in Michigan. Small business owners were wondering how they would weather the storm. That, on top of a severe shortage of toilet paper, made for some harrowing times. 3 days later, March 27th, the CARES Act came to the rescue, was signed into law, introducing the Paycheck Protection Program, among other things. The intent of the program was to keep folks employed and paid and help small businesses stay alive. Since then, it's been quite a wild ride with a lot of changing guidance, and many times issued a little bit too late to act upon. But let's go through the history. Applications started to be accepted on April 3rd. It was a mad dash, to say the least. The entire $349 billion of original funding was spoken for in less than 2 weeks, 1.7 million loans, and plenty of businesses were still unfunded at the end of that period. So that led Congress to refund the program with another $310 billion on April 24th. Time keeps moving on, and many businesses were nearing the halfway point of their original coverage period and still didn't know some key answers to questions on forgiveness. So May 15th, we finally see a loan forgiveness application with instructions that answer some of these big unknowns, such as how full-time equivalents are defined and how some of the reduction formulas work. So we think we've got our rules. Businesses start another mad dash to figure out how to maximize their forgiveness in the remaining time. But we're hearing from a lot of businesses that it's really hard to return to normal levels of operation, and they were asking for more time. And Congress responded with the PPP Flexibility Act, and this was signed into law June 5th. And it's a big game changer. It changes a lot of key terms of the program. So at this point, we knew we had some options for a longer coverage period, but we weren't sure on the details. And almost 2 weeks later, just yesterday, in fact, we saw 2 new applications replacing the May 15th version, and more guidance was issued. So along the way, we've had 48 answers to frequently asked questions and 19 interim final rules published by the SBA. There will undoubtedly be more, and we have a link at the end of the presentation to our website where we post updates, but it feels like we have the workings of the final framework, possibly with some additional fine-tuning still to come. So for anyone out there who doesn't already have a loan, the program is still open through June 30th. And the last stats from SBA indicated that there was still $146 billion of that second round of funding available. So let's get into this new act that was passed June 3rd, the PPP Flexibility Act. As a refresher, the original loan program, it was available for businesses with less than 500 employees, generally speaking. You could get a loan equal to 2.5 months of your prior 12-month average payroll. And these loans could be spent on 4 things: payroll, rent, utilities, or mortgage interest. To receive full forgiveness, businesses needed to spend it in 8 weeks with a minimum spend of 75% on payroll. And you couldn't reduce full-time equivalents or reduce salary or hourly wages and still keep that full forgiveness. So it was proving difficult. So June 3rd, we get some new rules here. We now have a 24-week coverage period option. All new loans after June 3rd will automatically be under that longer coverage period. If you had your loan prior to June 3rd, you can choose 8 weeks or 24 weeks. The 75% minimum on payroll was lowered to 60%, so that gives us a little more flexibility. There was some confusion over whether that 60% would be, if you didn't meet 60%, would you get 0 forgiveness? And that turns out to not be the case, luckily. So in a joint statement by SBA and Treasury, they said they would not interpret that as a cliff. What that means is that if you receive a $100,000 loan and you spend only $50,000, you're below the 60%, you'll still get forgiveness. And the way that works is you would take $50,000, your payroll spend, divided by 60%, and that's one of your possible forgiveness amounts. So that equates to $83,000 or so. This act introduced another FTE exemption, and we'll get into these FTE exemptions and the reduction calculations a little bit later. But in essence, businesses are dinged on the forgiveness amount if they reduce employment levels. There are certain exceptions, and now we have another one. And this one states that if you're unable to return to normal operating levels due to compliance with federal governmental regulations relating to standards of sanitation, social distancing, or other worker or customer safety requirements due to COVID-19, you won't get dinged for that reduction just because you can't get your levels back up to normal. The Act also extended another exception for the FTE reduction ratio, and that is the restoration of your February 15th employment levels. You now have until December 31st, 2020 at the latest to bring those levels back up. Okay, some new terms. So any loans after June 3rd are now going to have a 5-year repayment period. It was previously 2 years. For people who had their loans prior to this change, they said lenders and borrowers are not prohibited from mutually agreeing to modify those terms to be 5 years. So if you expect to have some piece of loan that's not forgiven, you want to be in touch with your lender to see if you can get that longer term in place. The deferral of payments changed a little bit. It used to be 6 months. We now can defer payments until you have a decision on forgiveness, okay? And in case you were thinking of just not postponing your application for forgiveness to defer those payments as long as you could, they put a cap on that. So you can't, once you've waited 10 months, they're going to start requiring payments. One give in the Flexibility Act was allowing all employers, even if you have PPP forgiveness, to take advantage of this deferral that was introduced in the CARES Act of Social Security tax. So employers are given a deferred period of time to make their deposits for the 6.2% employer portion of Social Security tax. For the remainder of 2020, you have to deposit that 50% at the end of 21 and 50% at the end of 2022. Previously, you weren't eligible for that once you had a forgiveness determination, but now you can continue to use that deferral, and that equates to an interest-free loan, which is good news for people in this current economic environment. So we had an interim final rule issued just this week that clarified how the extended coverage period would work with the $100,000 cap that was on employment on the amount of forgiveness for an individual employee. So non-owner employees, good news, you can spend up to $46,154 and get forgiveness for those people. Owner employees, not as good news. You're still subject to 2.5 months cap of your 2019 compensation. So basically, you aren't going to be able to get forgiveness on any more than what your original loan was based upon, which is the 2.5 months of 19 compensation. We don't have a great definition of owner employees. Seems to be that anyone that's an owner right now is subject to that. There's no de minimis ownership that we've seen. So there may be future guidance coming on that. Okay, so just yesterday we got 2 new application forms published. They can be found on both the Treasury site and the SBA site. The May 15th version, which was the original version, was 11 pages. It included the instructions in the form. We now have a 5-page form and 7-page instructions for the regular Form 3508 and a new 3-page streamlined EZ form with 4 pages of instructions. So who qualifies for the EZ and what does it get you? We've got 3 categories of borrowers that would qualify, and basically it's those folks that aren't going to be dealing with the FTE, full-time equivalent reduction ratios, and all the related calculations which can be involved. So if you meet one of these 3 categories, you can use the EZ form. If you're self-employed and have employees, you qualify. If you're a borrower that has employees but you didn't reduce any of their salary or hourly wage rates by greater than 25%, and you didn't reduce your FTEs, you qualify. Or if you didn't reduce salary or hourly wage rates and you meet the new definition for government regulations limiting your ability to return to full employment, you can qualify. So if you're one of these people, you don't have to submit Schedule A. You also don't have to submit any FTE documentation calculating your FTEs. You do have to maintain that, and the SBA has said that you can maintain that for 6 years, along with all your other documentation. Unfortunately, the spending documentation required to be submitted appears to be the same. And if you aren't familiar with the documentation requirements, you likely want to take a peek at that, because it is pretty cumbersome and requires a lot of documentation to be submitted to the lender. So those are available in the instructions. All right, so in loans as in life, we're all looking for forgiveness, and that's the meat of the matter. So let's get into maximize forgiveness. So first things first, we need to spend the money on qualifying costs within the coverage period. Payroll costs have to be at least 60%, and we have a definition of what's included in payroll costs. It's salary, wages, you can include hazard pay, bonuses, but you're going to be subject to that 100,000 pro rata cap we talked about. You can include employer-paid group health care. That includes self-insurance plans. You can include employer-paid retirement and employer-paid state and local taxes on employee compensation. So that's your state unemployment. Non-payroll costs. So you have to keep this limited to 40% to get full forgiveness. Mortgage interest falls into this. That's both on real and personal property. Rent and lease, also on real and personal property. Utilities, it falls under this. This is gas, electric, water, phone, internet, and transportation. So I think, keep in mind, just on the mortgage interest and lease, we want to clarify that those leases and mortgages have to have been in place at February 15th to qualify. You can't go out and use the funds on new mortgages or new lease agreements. Okay, so we spend our money, we're set, right? Well, you know, not so fast. We've got a couple reductions that might come into play that we want to avoid. So first is the salary reduction. You're going to get dinged if you've reduced your salary or hourly pay rate of your employees more than 25%. And that's compared to your first quarter pay rates, okay? So I'm not seeing a lot of this. I think employers are dealing with already a hard competition and with unemployment that includes another $600 a week of federal unemployment. So I'm not seeing big salary reductions, but keep that in mind, that your compensation will be reduced by that reduction calculation. FTE reduction rate, this can be significant now that we have the longer spend period available, but it can be a big reduction in your forgiveness. So the reason it's a big reduction is the loan forgiveness is going to be the lower of 3 amounts at the end. You've got your original loan amount, okay, so they say you can't get forgiven for more than your loan. We can't pull one over on SBA there. And we've got payroll costs limited to, or capped at, sorry, minimum at 60%. So you're going to have your payroll costs divided by 60% as your other potential loan amount forgiveness. And then you've got your qualified spend during your coverage period, less the salary reduction multiplied by your FTE reduction. And that's why it can be significant, and why we want to spend a little time making sure you know the exceptions to that reduction ratio, and if you don't meet one of those exceptions, how it works. So we've got 3 possible get out of jail free cards here with the FTE reduction. The first one is just don't reduce your FTEs, right? It seems pretty simple, but we need to know how that's defined, and it actually goes back to January 1st, 2020. So you can't have reduced your FTEs at any point since January 1st, 2020 until the end of your covered period. If you haven't done that, then you don't have an FTE reduction. If you don't meet that, we've got 2 safe harbors, okay? The first one is the new exception that was introduced with the PPP Flexibility Act. So this is, you can't bring back all your employees because you're complying with HHS, CDC, OSHA guidelines. Safe Harbor 2, okay, this is if you reduced your FTEs starting February 15th and ending April 26th, so you reduced your people during that time, then you restore them. And this is new information that came out yesterday with the forgiveness application. So you have to restore them by the earlier of December 31st, 2020, or the date of your forgiveness application. And you have to restore those to levels, your February 15th payroll level. So this gives you some flexibility. You obviously don't want to apply prior to having your employment levels back up to their February 15th level. It also clarifies that previously we had some guidance that just said at some point prior to December 31st, you will have to restore them. Well, this reads to me that if you restore them in July and then they fall again and you don't apply for forgiveness until October, you might still be subject to this FTE reduction. So be careful of those two things and be ready to apply for forgiveness once your levels are back up. So if none of the three previous fact patterns apply to you, this is how the FTE reduction ratio is going to work. You calculate your average FTEs during your covered period. Okay, so that's the 8-week or 24-week period that you've chosen over the average FTE during your reference period. You have three options there. They're listed out down below. So if you think this is going to apply to you, get comfortable with what your reference period FTEs are. You want to choose the lower of the three, obviously. And then you know what your goal is for getting those restored. And if you can't, you know what kind of reduction you're looking at. So because of this ratio, mathematically, while unlikely, there is a chance that your forgiveness amount in a 24-week period could be less than in an 8-week coverage period. And again, it's unlikely, but I spoke with a client just yesterday that was shutting down a significant portion of their operations due to some unforeseen circumstances, and they're about 8 weeks in. Well, if the remainder of the 24-week coverage period shows very low FTEs, it may be that the 8-week calculation is better for them. So we're going to run those numbers and see. In general, the 24-week coverage period is going to make forgiveness a lot easier for folks, and that's good news. I ran some simple numbers, and I think it's about, you'll get full forgiveness even if you're at about 50% employment levels. That seems to be how the math works out, given the higher 40% non-payroll eligibility. So that's good news for people. But again, you want to get familiar with this calculation and see if you can meet one of those exceptions. Okay, so what's still unknown and the big buzz out there in the news? We've got a few things here we wanted to touch on. Certification of need. This is the Shake Shack fallout. So at the beginning of the program, there was a lot of news about big companies seeking these loans that were intended for small businesses. It resulted in some buzz that there would be audits on the certification of need. So the original application had owners certifying that current economic uncertainty made the loans necessary. It scared a lot of people from taking the loans, and there was an opportunity to even give back loans. But since then, we've seen guidance that says anybody under $2 million is going to automatically meet the certification of need. Okay, so that's good news for if you're under 2 million. If you're over 2 million, there's a checkbox on the application saying you're over 2 million, and what that means is you're potentially subject to audit on this certification of need. So we don't know what that looks like, but you do want to have documentation in place that's going to support your case. I think, given the uncertainty pretty much every business was looking at, hopefully you can meet this. Maybe canceled contracts, days shut down, comparative income statements, uncertainty with your supply chain, all of those things are going to be good documents to have on hand. Privacy. So Secretary Mnuchin has stated recently that borrowers' identities will remain confidential, but keep in mind the application in the fine print indicated that the names of borrowers and amounts of loans were subject to freedom of information requests. So yet to be determined if that will be made public at some point down the road or not, but be prepared for that. Just yesterday, this third one, there was a House Small Business Committee hearing on the PPP program, and there's still a lot of pushback for the burden that these forgiveness applications require, all the documentation. So there's some talk about introducing certain thresholds that would allow for automatic forgiveness. I don't know if it'll be passed, but in the meantime, I'd prepare your documentation. This last one is on the tax side of things. So IRS came out and said that although the CARES Act says the cancellation or the forgiveness of this debt is not a taxable event, they found this code section 265 and think it applies to the tax deductions. So any tax deductions related to tax exempt income are not deductible under the code section. We've got some legislative push still to change that and questions about the timing. We have some clients that are coming up on a fiscal year end, don't know about forgiveness yet. Does that make their expenses non-deductible in the previous fiscal year or not until a forgiveness determination is made? So we just don't know the answers to that yet. And with that, I'll pass it over to Tom, who's going to talk about some cash flow considerations.
Thanks, Kim. Hey, great job walking through all those details. You know, the only other thing I would encourage everyone to do is really run your numbers on both the 24-week and the 8-week options. You know, one thing that is still hanging out there is the 24-week. There's no restriction on the expenses with what's defined. So, you know, if you were close within the 8-week and then you only needed another 2 or 3 weeks, you're really going to calculate a large forgiveness number over a 24-week period. So there might be some opportunity to offset some of the FTE concerns with a 24-week method. So I think it's really important to run through you know, both calculations and really see what numbers you're at. And I think the timing of filing the loan application will be critical, as Kim, you know, mentioned that you know, if you have an FTE concern, then you might be planning, you know, consolidating some operation, some future production orders to get your FTE up to meet that that safe harbor requirement. So those are really the key things to really, you know, kind of keep an eye on from a guidance standpoint, and then just from an execution on when and how you're going to file your loan forgiveness application. So transitioning over to cash flow modeling, you know, the PPP program was a tremendous boost for a lot of businesses that were really struggling with liquidity and payroll costs. But as that comes to an end, as people are starting to use all the funds, you know, I think it's really important to understand where that puts you and what does your next 30, 60, 90 days look like. So, you know, if you don't have a 13-week cash flow model, it might be something to consider at this point. You know, if you're unfamiliar with a 13-week cash flow model, it's a tool that really focuses on planning and visibility. You know, it really kind of gets your whole organization engaged into a single process for managing cash. And I think what it does is it allows you to focus on your key milestones for collections and payments, and really make sure you've got this mapped out in a way that you kind of understand what your working capital needs, especially in a ramp-up situation as you return to volume, you know, full volume or near full volume. Are you going to have the cash to support that increase in sales and inventory and labor you're going to need to get you from point A to point B? On the next slide, you know, I'm just going to talk a little bit about, you know, some of the specifics, you know, what's different about a 13-week cash flow model. So, you know, it's not a traditional statement of cash flow. You know, a 13-week cash flow model is, you know, it's dynamic to your business and your industry, but it's really a cash conversion cycle tool. So it's really cash-based. You're really looking at when you're collecting your cash, when you're spending, and what the timing difference is before what you have to spend and when you collect it. So, the 13-week horizon, this term really comes out of the banking industry. So a lot of you, if you've had, this is a common request from banks to say, hey, do you have a 13-week cash flow, or could we get your 13-week cash flow? Because, a lot of times when you go to your bank to ask for maybe some support or some help, they're generally asking for forecast, and they're generally going to ask for like a 13-week cash flow tool to see how you're going to use maybe some extra cash that you put into the business, and where is that going to put you in 90 days. So it's really kind of geared towards being an active document, something you're going to use to help manage cash and support decision making within the organization. But during difficult times or challenging times or uncertain times, this is really a tool that you should have in your organization to help with visibility and predicting on your cash flow side. So next slide, please. So just some things to consider. I think everyone has a pretty good understanding of the basics. Hey, here's my fixed my rents and my utilities. I got to be paid every month. My health care, but just some other things. Labor intensive work. You really need to understand, especially if you're in the contracting space or you've got project work where you're not getting deposits or you're not getting sufficient deposits, then you need to understand how you're going to fund that ramp up in labor or materials to get a project done to get to that next payment. And things like equipment needs. There's pent up demand that people have been inactive and now they're starting to get back into business, full speed. And so what kind of pent up demands do you have for fixed assets, for inventory, for all those types of things that maybe you've been putting off and now you need to work in a plan. So again, having a template, having an approach to systematically manage your cash and manage changing business conditions is really key as we kind of transition back into business and also just to give you that insight is if there is another slowdown, if after this initial pent up demand revenue slows down, where's your cash at and how are you going to manage through the ups and downs that I'm sure we're going to see during the rest of this year. So I think with that, I think that was the last slide. I think we're going to pass it over to Ryan to have him pick it up from here.
Thanks, Tom. Thanks, Kim. Yeah, I think naturally, as we start to kind of funnel this down right into cash flow and forecasting ahead, one of the areas that we've received more questions on, and then there are frankly more unanswered questions in the guidance that have been provided by Treasury and the SBA, but it's an area that we think we're going to learn more about here soon, is using retirement plan contributions towards your forgiveness calculation. And so although retirement plan contributions are defined as one of the payroll expenses, there are a lot of questions beyond that and not many answers. So as we've looked at this, and we'll kind of walk through what we believe are the steps, and I apologize, this is so fluid. We don't have slides today. This morning, at least, we'll have them updated for distribution here within the next day or so. But we really look at this as what steps can you take to be prepared as we learn more about how retirement plan contributions can be used towards forgiveness, or if they should be. First, and going back to Tom's focus, I mean, forecasting is critical. So as if you're coming to the end of the 8 weeks, or if you're looking at 24 weeks, forecasting is critical so you can identify if there are going to be any gaps in forgiveness, and if you need to find any additional qualifying expenses to maximize that forgiveness calculation. So I'd say step one would be estimate and then monitor. So if you look at some of those key areas to focus on as it relates to retirement plan funding, it would be looking at 2019 obligated yet unpaid retirement plan contributions. What payroll did you use from 2019 to qualify for your loan? Also looking at then the estimate for 2020 qualifying payroll, and as a result, the related retirement plan contributions you're going to be obligated to. So start gathering that information as you forecast ahead. Additionally, you're going to want to empower your officers to be able to make changes to how you fund retirement coming up. And again, that doesn't, you can't just do that overnight, frankly. And so most instances, you're going to have to look for a board resolution to authorize officers to make these estimated contributions in many instances. Additionally, you're going to want to review your retirement plan document to make sure that it allows you to make estimated pre-funding contributions to, again, we're typically talking about 401k and profit sharing plans. Next, after a board resolution really empowering your officers to make these unique contributions to retirement compared to the typical year, we'd really, at that point, really look for additional guidance. So delay making those contributions, really get prepared, and then we're going to look for more and additional clarification from Treasury and the SBA. So if you start to identify that you need some additional qualifying expenses, and you're thinking, okay, I've got a retirement plan, I have 2019 obligations, I'm going to have 2020 obligations depending on the type of plan you have. If you have non-discretionary contributions that you're committed to, as an example, get prepared and then again wait, frankly. And so examples of why we'd want to wait is, as of right now, if you look to use retirement plan contributions towards forgiveness, as of right now, you'd lose that deductibility of that expense. So that might require you, if you're going to use 2019, you're funding 2019 and counting that against forgiveness, yet you've already used that for tax purposes. That might mean you have to amend your 2019 returns. For 2020, it's a little trickier because we don't know what the year-end payroll is going to look like. You can estimate what this covered period may look like. But again, that's where working with your CPA, retirement plan consultant, and frankly, your record keeper is going to be very helpful because those three players are going to help with identifying what your plan allows and then how to execute on them. So again, delay, once you have the power to make those contributions in a slightly different rhythm than you typically do, then it's a matter of waiting for additional guidance. Next, and while you're waiting for additional guidance, a good exercise would be to identify what would be that minimum retirement plan contribution. If you look at what has been, you're committed to, but you haven't funded yet for 2019, and then compare that to any minimum contributions that you're going to have to make for 2020. A great example would be if you have a safe harbor retirement plan. So you're obligated to making those safe harbor contributions for this year, and potentially some non-discretionary match beyond that or employer contribution. Really identify what is that minimum retirement plan obligation. And so that's really, you think of that as kind of your floor, and then you can compare that to what is that additional amount of expense that you're looking for to maximize forgiveness. Those two numbers are really important and handy to have as you're continuing to wait for future guidance. Assuming there's no further guidance, so if we start thinking in terms of this is it, and it's really kind of a blank slate, the thought would be pay the minimum retirement plan contribution. So you have that minimum number based on 2019 committed yet unfunded or unpaid yet, and then what you're going to be obligated to for 2020, and look to use that during this covered period as an expense that would qualify and count against forgiveness. Again, if you're going to do that, you're going to want to coordinate closely with your record keeper, especially for those 2020 contributions. If you're going to make those in a short period based on estimated future payroll coming up this year, your record keeper may not be set up for that. You want to make sure you give them as much time as possible to be able to properly track and count those contributions. Again, as this is all new for everybody, of course. So, but again, more communication with your CPA, retirement plan consultant, and then whoever is your third-party record keeper. They're the three that really need to be talking to each other to help you through this process. A couple of disclaimers, and I know these are questions we get from time to time. Again, self-employed owners, so think Schedule C, and partnerships, LLCs taxed as partnerships, can't count their retirement plan contributions against forgiveness for the owners. As of today, again, retirement plan contributions used for forgiveness would not be deductible. But again, forgiveness, and I would say forgiveness is better than a deduction if you need it. And then critically, work with your accountant, your CPA, the people that know your business the best, cash flow from a tax and a cash flow standpoint. And then also make sure you've got a really qualified retirement plan specialist or consultant involved. Because again, this is complicated it's moving quickly, and you're going to want to make sure you're working with somebody who's got their finger on the pulse of what is current. And then again, pulling in that record keeper as soon as possible, because in the end, just because you've figured out how much you want to fund, when you want to fund it, and then you go to actually physically process that contribution, your payroll or your record keeper may not be prepared to accept it and properly count it. So again, you're going to want to have a conversation with them as soon as possible. And if you can, pull those three stakeholders and partners of yours in on a conversation together, that should streamline the whole decision-making process. But again, the big theme here would be get prepared, empower yourself, empower your officers to make those accelerated contributions, if you will. Talk to your service providers if you're looking at using retirement plan contributions to count against forgiveness, especially. And then wait and monitor all the future additional guidance from Treasury and the SBA. And in the end, yesterday we had some additional guidance that impacted retirement plan contributions, and it seems like every week there's more to it. That's it from the retirement plan front. Again, if you do have questions, please, we see a couple of questions coming through on the chat function. Please continue to enter those. And again, we've got a little bit of time here before 11 to field some of those questions.
Perfect. Ryan, thank you so much. And yes, we do have a few questions coming in here, so I'll go ahead and jump right in. The first question being, can you spend more than 60% on payroll if over 24 weeks you only spend on payroll cost and use 100% of your loan?
Yes. The 60% is a minimum, so you can spend more on payroll.
And are dental and vision considered part of healthcare premiums?
Yes.
All right, the next question. In various guidance, the topic of interest has been defined as mortgage-related interest and in other cases, all senior debt interest. What would you say on this forgiveness expense?
And it has to be secured. So whether it's secured by real or personal property, that qualifies. Tom, do you have any clarification?
Yeah, I would say the one that gets the most question is a line of credit interest, because there is some question about whether, if it has a UCC filing of all assets, whether that satisfies a personal property requirement. So I'd say that one is still a little bit gray, but definitely any personal property loans on equipment or mortgages do apply. I think the line of credits are one of those things that I think there's gray area, and then if you've got other areas to maximize forgiveness, that might be a more conservative route unless additional guidance comes out.
All right, the next question, we kind of have two in one here. Under the 24 weeks, do you have to wait for 24 weeks or can you apply at that point you meet the requirements?
Yeah, this was a big unknown. Go ahead, Tom.
No, I was just going to say, the current application is you have to define which method, which coverage period that you're going to select. So at the minute, it would appear that you're either selecting an 8-week coverage period or a 24-week coverage period. There hasn't really been any guidance that says that can you submit prior to 24 weeks if you've got all your numbers calculated and you meet your forgiveness. There hasn't been specific guidance stating that you can at this point.
Yeah, I would just say because of the FTE calculations and requirements that you maintain certain employment throughout the coverage period, I think it's hard to apply before that period is over under current guidance.
And this one is a little similar, but the question is, do we have to wait the full 24 weeks to apply for forgiveness if all of the PPP funds have been exhausted before then?
Yeah, so again, you know, you've got both your spend requirements, but you also have FTE requirements, and those are calculated over the entire coverage period. And so right now that's 8 or 24 weeks. So if you're using the 24 weeks, you won't know those FTE numbers until the end of your coverage period.
All right, the next question is, are you saying that we need to fund the employer safe harbor contribution or accurate it on our budget if it's included in the forgiveness calculation?
You would need to fund it, and this is where this gets tricky, right? You know, you think in terms of safe harbor contributions and other employer contributions where your plan document might require a last day of plan year employment to qualify. That's where it gets into the uniqueness of every plan. But in this instance, you'd need to fund a portion of that during this period.
Thanks, Ryan. The next question is, we had 2 child care center locations. We are closing one on June 12th, 2020 prior to the pandemic. So we were not adding staff. We have lost staff due to voluntary quit. Will this impact our FTE requirements?
You are allowed an exception for voluntary departures. You're also allowed exceptions for people you give a good faith rehire offer to and they turn it down. Also terminations for cause. So those are all allowed exceptions, and the way it works is you get to include them in your numerator of the FTE reduction ratio.
Okay, thanks, Kim.
I think the only, was there a comment there that they had already planned to shut down one of their sites?
That is how it's reading. And she just clarified, yes. So it was already pre-planned before the pandemic even happened.
Okay, so that one's probably going to be a little, I mean, that's an undefined, you know, assuming, let's say that all those people were laid off because of the facility shutting, you know, that one might be a little more challenging if you know, now you're sifting through those, the employees from that site. Did they leave voluntarily? Were they laid off because, you know, so that one is a pretty unique, you know, situation that, you know, they'll just, I don't see a clear, you know, exception, you know, for something like that where we were planning on shutting down and we did shut down and now that's affected their FTE. So at the minute that's something that, you know, is going to need some probably closer evaluation, because I don't see a clear, if people were laid off because of that, I don't see a clear exception for that at the minute.
Perfect, thanks, Tom. A few more questions here. How are owner premiums calculated for forgiveness?
Healthcare premiums?
I believe so.
So for for S Corp shareholders, that's going to be included in their compensation. Can you reread the question?
Yep, so she kind of grouped a bunch of stuff together. So I'll read all of it together. Are dental and vision considered part of healthcare premiums? How are the owner premiums calculated for forgiveness? Is it when the utility is paid or the period that it covers that needs to fall in the 8-week or 24-week period?
Well, I'll start backwards. I can take the utility. You know, the non-payroll costs are incurred and paid. So the SBA did give guidance that if you had past due utilities, you could pay them in the coverage period. And then if your coverage period expired, let's say on June 29th, if you had a bill that covered half of that time period that wasn't paid until, let's say, July 15th after your coverage period, you can accrue up to the end of your coverage period as long as your bill's paid on time. So you do have some flexibility to pay prior, utility bills, and then if you're paying in arrears like most people are, you can prorate that last bill up until the last day of your coverage period.
Perfect.
And then I think we already answered vision and dental are included. I forget the middle question.
Yeah, the owner comp, which, for certain people is going to include their premiums, is going to be capped at the 2019 levels. So I'm not sure if that answers the question. You're going to include your employee premiums, actually, and then you're going to have the owner piece capped at your 2019 comp.
Perfect. It looks like we have one more question here. Is the start date of counting your 8 to 24 weeks begin with the day we received the loan?
The default coverage period is the loan origination date. If you have biweekly payroll or more frequently, you can use an alternative coverage period, and that starts on the first day of your next payroll period after the loan origination date.
All right, and then it looks like we had someone just asking, they're still a little confused about the FTE comparison.
The ratio, if you don't, so let's just go through, I guess. So you have 3 exceptions. One is you didn't reduce your FTEs from January 1st to the end of your coverage period. You have 2 safe harbors, meaning you can't operate at normal operations because of government regulations. Then you don't have a reduction. The second is if you had a reduction between February and April, those dates, and then restore it by 12/31/20 or the date of your forgiveness application. Okay, so if we don't meet any of those, then we calculate a ratio of your average FTEs during your coverage period divided by your average FTEs during your reference period. So I'm not sure if that clears it up, or maybe we can get some clarification on that question.
There was one more. Is the comparison from 12/30 or PPP received compared to the end of the PPP period?
The reference, I was just going to say the reference periods are 2 defined periods, either February 15th through June 30th, 2019, or January 1st, 2020 through February 29th, 2020. Seasonal has the option to pick a consecutive 12-week period. I believe that was what, May 1st through September 30th of
September
2019?
15th.
September 15th. Okay.
Yep, so I went back to the slide just so we could see this visually. So if we're talking about the restoration of FTEs, it's by 12/31 you have to restore to your February 15th levels. And there are so many FTE numbers flying around, and it gets very confusing. You're going to have to know your FTE numbers. Probably, I don't know, 6, 7 different numbers here. It's crazy. So I can see where the confusion is. Hopefully that clarifies things. So if you're restoring by 12/31, if you're looking for this safe harbor number 2, you need to restore to the levels February 15th of 2020.
Perfect. All right. The next question is there an alternate payroll period associated with the 24-week covered period similar to the one available with the 8-week period?
Yeah, the same alternate coverage period methodology applies to both the 8-week and the 24-week coverage period. So it's exactly the same. You can, if you got your funding, if you got your loan originated on a Wednesday and you're a weekly payroll, you could start your payroll alternate coverage period the following Monday, just so you can get a clean cutoff on either your 8 or 24-week period.
All right. And the next question is, how do you calculate that 2019 cap for the owner-employee insurance premium? Do you have to use the 15.38% of all of 2019 for the owner as you max for an 8-week period?
Well,
If you're,
I think the go ahead, Kim.
oh, I was just going to say, it depends. So the 8 weeks is that 15,000 number. If you choose the 24-week coverage, you're going to be at 2.5 months of your 2019 comp. So that would include premiums for your owners.
All right, and the next question is in regards to a utility bill. So if your utility bill paid on 6/28 is paid during your 8-week period, the period is ending 6/29, but it covers a full month outside of your covered period, July, is that payment still eligible for forgiveness?
Yeah, it is. All payments inside the coverage period for utilities are eligible.
Perfect. Well, I don't see any additional questions coming in at this time, and this does get us right up to that 11 o'clock mark. So I just want to thank you, all three of you so much, Kim, Tom, and Ryan, for your time, for all of the information you were able to provide today. I know it was extremely helpful to everyone who's viewing. And just a reminder, this will be on our website within 24 hours. So thank you again. We truly, truly appreciate your time and all of the knowledge you were able to provide today.
Thanks, everyone.
On that note, I hope everyone has a wonderful day. It looks like it's going to be a beautiful weekend, so get outside and enjoy. Stay safe, stay healthy, and we hope to see you at our next webinar. Thanks, everyone.